So before we get started, check out the following links in the description box below as highlighted in the image shown. So you'll be able to get our past papers, our link to our official website, link to accreditations, our link to donation page, and contact details in the description. So once you'll be watching a certain video of any lesson or of any past paper, you'll be able to get all these links, and you can be able to get to download past papers, to reach to our official website. You'll be able to see links to our accreditations so that you can see which authorities have accredited us. You'll be able to reach to our donation page as well as our contact details.
Welcome back to another lesson. We continue with our revision series. In this video, we shall focus on an exam that was done in April 2024. And we are going to look at question number 41 to question number 50, where this is the new mode of testing. Students are allowed to choose from the multiple choices. Now, let's begin with question number 41, where you are told the credit policy of Kikwetu Limited is 1.5/10 net 35. At present, 30% of the customers take a discount. 62% pay within the net period, and the rest pay within 45 days of invoice. What would receivable be if all customers took the cash discounts? Now, ask yourself, how do we find receivables? Receivables is given by actual sales divided by number of days in the period, times 10. Now, look at this. If you read this question correctly, you realize that there is no place where the actual sales have been mentioned. Now, what do we say here? What would receivable be if all customers took cash discount? Lower than the present level? No cash, no change from the present level? Higher than the present level? Unable to determine without more information? Absolutely. Because in this question, you have not been given actual sales. Therefore, there is no way you can proceed to determine receivables without the actual sales. We move on to question number 42. When a firm needs a short-term loan for specific purpose, the bank loan will likely be what? Yeah, you need a loan for a specific purpose. Then compensating balance arrangement, revolving credit arrangement, transaction loan, line of credit. If you look at this question, is that the firm need a short-term loan for specific transaction. Therefore, this loan will be a transaction loan. It is a short-term loan for a specific purpose. That means for a specific transaction. A transaction loan. We move on to question number 43, where you are told the cost of equity capital is all of the following except what? In other words, you are told all the information here, 3 of this information provided are good, except one concerning the equity capital. Cost of equity is the minimum rate that a firm should earn on the equity finance part of the investment. Absolutely. That is the cost of equity. A return on the equity finance portion of the investment that at worst leave the market price of the stock unchanged. Correct. By far the most component cost of estimate. Absolutely. Generally lower than the before tax cost of debt. No. When you see debt and equity, they are both component of capital. Therefore, they are not anywhere related. So you cannot say that the cost of equity should be lower than the cost of debt, because when you are getting equity, does not foresee a situation where you are going to get debt. So we can say this one is not correct. We move on to question number 44. In calculating the proportion amount of equity financing employed by the firm, we should use what? Listen, when you want to find out the proportion of the amount of equity, then here you need to use what? Is it the common stock equity account in the firm balance sheet, a book value of the firm, the current market prices per share of the common stock, the sum of common stock and preferred stock? You see here you are saying in calculating the proportion is like the weight. We use the current market prices. We use the current market prices. Number 45, you are told, the market values are often used in computing the weighted average cost of capital, WACC. Because, why do we use this? This is the simplest way to do calculations? Absolutely no. This is the only way of doing it? No. This is the very common mistakes? No. This is the consistent with the goal of maximization of shareholders' value. That is it here. Yeah. The WACC, we use the market rates because it consisted with shareholders' wealth maximization. Question 46, you're told, Kawira Limited has paid shillings 10 per share, annual dividends on shillings 100 per value. The preference share has a current market price of 96. The firm marginal tax rate is 40%. The company plans to maintain its capital structure. You are told the component cost of preference shares of Kawira Limited will be what? Now, how do we find the cost? The cost of preference shares is obtained by dividends over the market price times 100%. If preference dividend, of course. Preference dividends here, you're told that Kawira has paid shillings 10 of the annual dividend. That means 10 is the dividends. 10 is the dividends. And the market price is 96. The market price is 96. 96 times 100%. This will give you 10.42%. This will give you 10.42%. Question number 47. You are told a critical assumption of the net operating income approach to valuation. Yeah? What are the assumptions of net income approach to valuation? We are saying that the debt and equity levels remain unchanged. Not really. The dividend increases at a constant rate. That the net interest expense and tax are included in the calculation. The most common is that the cost of equity remain constant regardless of the changes in debt. Yeah. So it should be this one. This one remain constant regardless of the changes in debt. Let's move on to question number 48. You are told which one of the following statement is not an argument for the relevance of dividends. This one is straightforward here. Dividends are never declared or determined by the shareholders. This one is not an argument for the relevance of dividends. dividends are not determined by shareholders. Shareholders, they only receive dividends after approval by the board of directors. Therefore, they are not part of the argument when it comes to dividends. The following statements are true in relation to the stock split, except, you see, when you split a stock split, they can affect the market price, and also they increase the amount of shares, and also the proportion of ownership is not changed. What it does not affect is the retained earnings. Retained earnings are never changed by stock split. This one. Stock split don't change the retained earning. And finally, you are told that here, the dividend payout ratio is equals to, how do we find the dividend payout ratio? Is obtained by taking the dividends per share divided by earning per share times 100%. Therefore, from this, we are saying that the correct one is dividend per share divided by earning per share, B. That is the correct way of finding out the dividend payout ratio. Otherwise, that is how you are to, if you had to do this exam, this is how you are to attempt that part of the questions. That is question number 41 to question number 50. We have previously provided videos of the previous questions. You can check and read more on the same. For now, we are going to stop there. You can further readings, you can confirm the notes given to you on our website and other materials that are available to you. So we stop there. We meet in our next video. Goodbye.
So if you like this video, you can always enroll with us. You'll be able to access more of these revision sessions. And also you'll be able to find well done lectures or pre-recorded videos for all the KASNEB courses as well as CHRP. And in case of anything, you can always reach us out. We have our contact details on the screen. Feel free to call, feel free to WhatsApp anytime. So thank you, and let's meet in our next session.